Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
Experience is a wonderful thing. It enables you to recognize a mistake when you make it again. I treat my body like a temple. Unfortunately, it's an ancient ruin where tourists litter and the structural integrity is questionable. Committee, a cul-de-sac down which ideas are lured and then quietly strangled. Budget, a mathematical confirmation of your suspicions. Breaking news, used to mean the president was shot. Now it means a celebrity bought a sandwich.
Here's a reminder that markets don't always reward size, they reward neglect. This chart shows Bulgaria's Sofex index quietly smoking global peers early this year, while big-name markets trip over their own expectations. Thin liquidity, low valuations and zero crowding means even modest inflows move prices fast. Meanwhile, larger emerging markets are busy digesting rates, FX nerves, and investor deja vu. This isn't a global growth story, it's a positioning story. When capital looks for asymmetry, it doesn't knock on the biggest door, it slips through the least watched one. The takeaway, in early cycles, scarcity beats familiarity. This chart shows India's silver imports hitting record highs on a rolling 4-month basis, clean, vertical and hard to ignore. This isn't jewelry seasonality, it's behavior. Silver is cheaper than gold, useful in industry and increasingly treated as a hedge when inflation anxiety meets growth optimism. Add solar demand, manufacturing capex and a population that trusts metals more than narratives and you get this surge. The macro signal, households and industry are front-running uncertainty with something tangible. When paper assets argue, silver quietly gets invited in. China just printed a $1.2 trillion freight surplus. Record-breaking and politically favorable. Exports to the US fell, but Beijing simply rerouted the cargo. Africa, ASEAN, Europe, Latin America, everyone else picked up the slack. Same factories, same volumes, new destinations. The problem with this? Those destinations are running out of patience. When surplus grows global, pushback usually follows. Tariffs, probes, or strategic concern, press releases. This isn't a demand miracle, it's supply persistence meeting weak domestic absorption. China keeps producing, the world keeps absorbing until it does not. Trade imbalances don't disappear, they migrate and then get noticed. This chart is pure scale economics. BlackRock's assets just hit $14 trillion, with $342 billion arriving in just a single quarter. That's not stock picking brilliance, it's plumbing dominance. ETFs, retirement flows, and institutions outsourcing decisions to rules and benchmarks. When uncertainty rises, investors don't choose opinions, they choose infrastructure. The second order effect matters. Capital gets bigger, broader, and more synchronized. Price discovery thins, correlations rise, and the market increasingly means a handful of allocation committees and index rules. This isn't about BlackRock winning, it's about markets becoming more centralized quietly. This dashboard reads like a controlled deceleration and not an accident. December shows growth cooling across indicators, but the engine's still running. Hiring is up 13% year on year, GST collections crossed 1.75 lakh crores, and liquidity remains supportive. What's easing is momentum. Services PMI slipped to 58, its lowest in 11 months, telling you that demand is normalizing and not vanishing. The macro mix is familiar. Real growth steadies at around 6 to 6.5%, while inflation quietly does more of the nominal heavy lifting. That's not a bug, it's how late cycle resilience usually looks. Consumption isn't collapsing, capex isn't panicking, and the labor market is holding the line. This chart is the quiet horror movie of macro. Global debt has ballooned by over $100 trillion since 2016, and interest costs alone are racing towards $4 trillion a year, roughly the size of India's entire GDP, just to service this bill. The interest bill, rather. Advanced economies are staring at debt to GDP levels not seen in the last 2 centuries, and refinancing is getting pricier and not easier. So what's the endgame? Defaults are politically toxic and systemically messy. Inflation, on the other hand, is subtle, deniable, and very reusable. Central bankers won't announce it, but negative real rates are doing the heavy lifting already. When debt is this big, price stability quietly becomes negotiable. India's FY26 export story is not a victory lap, it's a selective sprint. April to December exports rose a modest 2.4%, But electronics did all the heavy lifting, jumping 35%, with engineering tagging along at a polite 4%. The US bought 10% more despite tariffs, proof that demand sometimes ignores policy memos. While China roared back with a 37% surge as supply chains quietly reshuffled. The drag, Europe blinked, Netherlands down 21%, and the UK off 7%. Petroleum exports led 14% thanks to prices, and parts of textiles looked tired. Bottom line, this isn't a broad-based export boom, it's India climbing the value chain, one circuit board at a time.